Hello, friends. Almost no one caught this. Not the financial blogs, not the retirement planning websites, not the people who follow Social Security news closely and pride themselves on staying ahead of benefit changes. This particular SSA move landed so quietly in such deliberately understated language, buried so deep inside a processing update that most people who cover this space did not notice it happened at all. But it happened. It is in effect right now. And for the retirees it applies to, and there are more of them than SSA's communication style would ever suggest, this move is already changing what lands in their monthly deposit, whether they know about it or not. I noticed it. I went through the language, traced it back to the specific policy mechanism it touched, and mapped out exactly which categories of retirees are sitting inside its reach right now. And what I found is the kind of thing that makes you understand why this channel exists, because the gap between what SSA quietly does and what actually reaches the people it affects is not a small gap. It is enormous, and it has a real dollar cost for every month it goes unclosed. Today, I am closing it. I am going to tell you exactly what SSA moved, who it affects, what it means for your specific deposit, and what the action window looks like right now for the retirees who have something to gain or something to lose, depending on whether they find out about this today or 3 months from now. Stay until the very end, because the last category I cover is the one SSA moved most quietly, and it is the one with the most direct impact on the largest number of retirees watching this right now. And if SSA Now is the channel that catches what everyone else missed and brings it to you before it costs you something, subscribe right now and turn on the bell. This is exactly the kind of move that the people subscribed here find out about in time. Everyone else finds out after the deposit already.
Changed. Let me start with something important before I get into the specifics. SSA moves are rarely announced with fanfare. The changes that matter most to individual retirees almost never arrive with a press release or a personal notification. They go into the Federal Register or into internal processing guidance. They take effect on a schedule, and the people most affected by them find out one of two ways. Either someone who tracks this stuff closely catches it and translates it into plain English, or the retiree opens their banking app on deposit day and notices the number is different from last month. One of those two ways gives you time to respond. The other doesn't. What I am about to describe falls into the category of things SSA moved without announcement, without personal notification, and without any clear effort to reach the retirees it directly affects. The move is real, it is documented, it is already running through the system, and it touches 4 specific areas of retiree benefits that interact with each other in ways that make the total impact larger than any one piece suggests on its own. Here is what SSA moved. The first move, a quiet recalibration of how earnings-based benefit adjustments are flagged and prioritized in the processing queue. This is technical language for something that affects a very practical outcome. When you continue working after claiming Social Security and your annual earnings qualify you for an automatic benefit increase, that increase is supposed to process on an established timeline. What SSA moved is the internal flag system that determines which accounts get prioritized for review and which ones sit in a secondary queue waiting for manual verification. Under the previous system, accounts were generally processed in the order they entered the review cycle. Under the updated system, SSA has introduced a tiered prioritization framework. Certain account types and earning patterns move through the queue faster,
while others are routed for additional verification steps that extend the timeline before any adjustment appears in the deposit. The practical consequence is that retirees who are expecting a benefit increase from 2025 earnings may be waiting longer than they anticipated, not because the increase is not coming, but because their account has been routed into a verification tier that adds time to the process. And without any notification that this routing happened, the retiree has no way to know whether to wait or to follow up. If you worked in 2025 and your benefit has not reflected an increase yet, do not assume everything is on track. Log into ssa.gov and verify that your 2025 earnings have posted correctly to your record. Then call SSA at 1-800-772-1213 and ask specifically whether your account is in standard processing or has been flagged for additional verification. If it has been flagged, asking about it directly accelerates the resolution in a way that simply waiting does not. The system responds to contact. Silence extends the queue. Second move, an update to how IRMAA surcharge brackets interact with mid-year income changes. Almost no one noticed this one, and it is the move that made me want to make this video specifically. IRMAA, the Income-Related Monthly Adjustment Amount, is the surcharge applied to Medicare premiums for retirees whose income 2 years ago exceeded certain thresholds. It comes out of your Social Security deposit automatically. Most people who pay it either do not know they pay it, do not know why, or do not know it can be challenged. What SSA moved is the internal framework for how mid-year income change documentation is evaluated when a retiree files SSA 44. the appeal form for life-changing events that cause the income spike SSA is basing the surcharge on. Previously, the documentation standards were relatively uniform across all qualifying life-changing events. Under the updated framework, different types of life-changing
events now carry different documentation weights, meaning a retirement event, a property sale, a divorce, and a reduction in work hours are evaluated through slightly different lenses when SSA reviews the appeal. Why does this matter to you specifically? Because if you previously filed SSA 44 and were denied, or if you were considering filing but held back because you were uncertain whether your specific situation qualified, the updated framework may change the outcome. A denial under the previous documentation standard does not automatically mean a denial under the current one, and a situation you thought was borderline may now fall clearly within qualifying criteria under the revised evaluation approach. If you are paying an IRMA surcharge right now, meaning your Part B premium exceeds $185 per month, and your 2024 income was elevated due to any event that no longer reflects your current financial reality, the updated SSA 44 framework is worth revisiting. Download the form at ssa.gov. Document your specific life-changing event with whatever supporting evidence you have. File it. The updated evaluation framework gives borderline cases a better chance at approval than they had before SSA made this move. And if you were previously denied, ask SSA specifically whether a reconsideration is available under the updated documentation standards. That question is worth asking. The answer may surprise you. Drop a comment right now. Tell me, are you currently paying an IRMA surcharge? And did you know before today that the appeal process just changed? Because I want to know how many people this move directly affects in this community right now. Third move, a shift in how overpayment notices are sequenced relative to recovery actions. This is the move that is creating the most confusion on the ground right now among retirees who are suddenly seeing their deposit reduced without understanding why the timeline unfolded the way it did. Previously, there was a relatively consistent gap between when SSA sent an overpayment notice and when recovery deductions began appearing in monthly deposits. That gap gave retirees time to read the notice, understand what it said, and take action before their check was affected. Under SSA's updated sequencing protocol, that gap has compressed in certain account categories. For some retirees, the notice and the recovery deduction are now arriving in much closer sequence, close enough that the deposit changes before the retiree has had a realistic opportunity to respond to the notice. What this means practically is urgent. If you receive an overpayment notice from SSA, the 60-day appeal window printed on that notice is your legal protection, but the deposit impact may now arrive before you have used that window. Do not wait for the deposit to change before taking action. The moment a notice arrives, respond to it. Your three options remain the same regardless of the updated sequencing. A formal appeal if you believe the overpayment amount is wrong, Form SSA 632 for a waiver request if the overpayment was not your fault, or if repaying it creates genuine financial hardship, and a negotiated repayment arrangement if you acknowledge the balance but cannot sustain the rate SSA is applying. What changed is the urgency of acting immediately. Under the old sequencing, there was breathing room. Under the updated protocol, that breathing room has shortened significantly for certain account types. If a notice is sitting on your kitchen table right now, today is the day to respond to it. Not this weekend, not when you get around to it. Today. Call SSA at 1-800-772-1213 and tell them you received an overpayment notice and you want to discuss your options before the recovery deduction begins. That conversation needs to happen now. Fourth move, and this is the one almost no retiree noticed, a clarification to the rules governing retroactive benefit payments for approved appeals. I saved twist one
for last because it is the move with the most direct upside for the people it applies to, and almost nobody is talking about it. When SSA approves an appeal, whether it is a benefit amount dispute, a recalculation request, or a reconsideration of a denied claim, the approved correction does not just apply going forward. It applies retroactively to the date the correct benefit should have started. That retroactive payment is supposed to arrive as a lump sum alongside the first corrected monthly deposit. What SSA moved is the internal processing rule that determines how far back retroactive payments can reach, specifically for appeals that involve documentation gaps or delayed filings where the original correct benefit date is disputed. Under the previous rule, SSA used a relatively conservative interpretation of the retroactive start date in cases where the documentation trail was incomplete. Under the updated rule, SSA is required to use the date most favorable to the claimant when documentation supports multiple possible interpretations. In plain language, if your appeal gets approved, you may be entitled to more back pay than you would have received under the old rule. More months covered, a larger lump sum arriving with your first corrected deposit. This matters most for two groups: people whose appeals have been pending for an extended period. The longer the appeal took to resolve, the more months of back pay the updated rule potentially covers. And people who have not yet filed an appeal but believe their current benefit amount is wrong, because filing now under the updated retroactive rule sets a more favorable start date than filing later would. If your benefit amount has ever felt wrong to you, if the number SSA gave you when you filed never quite matched what you calculated, if an adjustment you were expecting never arrived, if a recalculation that should have happened seems to have been skipped, the updated retroactive payment rule makes right.
Now the most favorable moment to initiate an appeal or reconsideration request. Call SSA and ask to begin the reconsideration process. The date of that call becomes part of your retroactive eligibility calculation. Here is the common thread running through every move SSA made. Each one changed something real. Each one has a direct dollar consequence for the retirees it applies to. And not one of them arrived in anyone's mailbox with a plain English explanation of what changed, who it affects, and what to do about it. That is not unusual. That is standard operating procedure for how SSA communicates with the people who depend on it most. The move happens, the system updates, the deposit changes, and the retiree figures out what happened somewhere between the bank app and a phone call to SSA that puts them on hold for 90 minutes. SSA now exists so that the figuring out happens before the deposit changes, not after. So here is what to do today. Log into ssa.gov and verify your most recent earnings are posted correctly. Check your Part B premium, and if it exceeds $185, revisit SSA 44 under the updated documentation framework, especially if you were previously denied. If an overpayment notice has arrived, respond to it today, not later this week. And if your benefit amount has ever felt wrong, initiate a reconsideration request now while the updated retroactive payment rule works in your favor. 4 moves SSA made. 4 actions that put the advantage back on your side. Almost no retiree noticed what SSA did. You did. If SSA now caught something today that no one else was talking about, and it matters to your retirement income, subscribe to this channel and turn on the bell. Every quiet SSA move, every buried policy update, every change that lands in your deposit without explanation, I find it, I translate it, and I bring it here before it costs you something. And please share this video with someone you know on Social Security right now. They almost
Certainly missed this move too. Whether they find out today or after the deposit changes is a difference that matters. I will see